Hello, everyone, and welcome to Overbond's National Investor Conference Call. My name is Eric Buckingham, Director of Sales at Overbond. I'll be officiating today's call. With me today, we have Tony Sevchek, Head of Sales, who will be speaking to the topics at hand and answering questions during the Q&A portion of our call to happen towards the end of the scheduled time. Before we begin, could you introduce yourself and your background in capital markets?
Hi, sure, Eric. I have over 23 years of experience in capital markets and alternative investments. Prior to Overbond, I was Managing Director of BMO Capital before heading off over to Bank of America Merrill Lynch to become Head of Fixed Sales and then Head of Sales at Dundee Global Investment Management.
Great, thanks, Tony. Before we get started, let's go over the agenda for today's call. To begin with, we're going to discuss the financial technology environment and trends we saw in 2016. Next, we'll go over the occurrences in debt capital markets for 2016 and what we can expect in the upcoming year. Finally, we'll discuss the role of technology in growth initiatives and regulatory considerations. So, Tony, let's start with something you and I are both familiar with, financial technology. Tell us about the landscape and some notable facts from 2016.
Sure, Eric. The momentum surrounding financial technology is incredibly strong. In 2015, investment in financial technologies hit $19 billion. We are already on track to surpass that this year. In capital markets specifically, the theme surrounding this movement is collaboration. Collaboration with all parties involved to evolve the market ecosystem.
Great. It's no secret that capital markets has been resistant to change, especially involving financial technologies. What do you have to say about that?
Well, Eric, the world is changing, and capital markets will change with it. Ernst & Young actually stated this year that innovation within capital markets is no longer optional. Investment banks are faced with high structural costs, heavy capital charges, and stagnant returns. They have been focused on delivering changes mandated by regulators and external threats. These regulatory deadlines are exhaustive to meet and result in a lack of focus on investing in initiatives to ultimately build innovative ways to serve clients. These same financial service providers are working with financial technology companies around the world to act to supplement this. This is the very reason financial technology growth has occurred so rapidly, and we can be assured that capital markets will be no stranger to this.
Great, thanks. Moving on to debt capital markets, could you walk us through some themes we encountered in 2016 and what this means for the year ahead?
Yeah, this year we saw four main themes pertaining to debt capital markets. Let's start with fixed income markets. We saw two things occur in 2016. Policy-driven market volatility and widening policy divergence. In terms of policy-driven market volatility, we saw record low bond yields in the UK in the wake of Brexit, sending global bond yields to record lows. However, since Trump's election victory in the US, inflation expectations have been surging rapidly, leading to the sell-off of US long bonds and a rally in broad equity global markets. In terms of widening policy divergence, we are seeing discrepancies between the US and the rest of the developed markets, especially in Europe. Whereas the ECB is likely to extend its €80 billion a month bond purchase program, the Fed in the US is poised to hike its interest rate in December. The two diverge at a time when their economies are on opposite ends of the spectrum. While the Eurozone struggles with high unemployment, weak inflation, and near flat growth, the US economy has seen remarkable strength. That will leave yet no choice but to move the US to higher interest rates. Relating this to back home, like Europe, Canada is unlikely to follow in the Fed's footsteps anytime soon.
And what are the investment implications of this?
Well, first, players in the market must stay alert to the potential of rapidly rising interest rates. In many markets, most notably the US, duration management is the key. Short bonds are more likely to outperform long bonds. Secondly, high-quality yields can withstand the rising rate environment due to its high coupon rate and narrowing credit spreads in a growing economy.
Great. What else can we expect in the year ahead, John?
Well, with bond yields reaching record lows this year, it can be expected that global interest rates will continue to be low, driven by continued easing from European Central Bank and the Bank of Japan. In addition, growth prospects and lower for longer inflation in the Eurozone, Japan, and the UK, and to some extent in the US, indicate an unsupportive backdrop for higher interest rates globally. In 2016, we saw companies like Unilever and Toyota issue near 0% yields, and Henkel and Safari issue with negative yields. Further, as reported by Bloomberg, average corporate bond yields in Japan were reported at 0.01%, down from 0.033% a year earlier. Another big theme this year was robust bond issuance. Corporate bond issuance will remain robust, but may contract marginally unless other factors like M&A come into play. Government bond issuance is likely to pick up the slack as many governments will continue to take advantage of the low interest rate environment. For example, Canadians are seeing our Prime Minister Justin Trudeau committing to a highly accommodative fiscal policy that includes large infrastructure spending, financed primarily through the issuance of debt. In the U.S., the Trump administration is also supportive of increasing infrastructure spending, which in turn will result in debt issuance ranging from municipals to U.S. treasuries.
Great. And what are some of the factors we should watch out for in terms of this?
Well, in 2017, the rising rate environment in the U.S. and dovish stance from the Bank of Canada will potentially attract more Canadian corporate issuers, example Rogers, who used to frequently come to the U.S. market to issue in Canada market instead. Also, Canadian issuers with heavy U.S. operations might choose to issue Canadian bonds as well and then swap them back to U.S. dollars. Additionally, Trudeau and Trump's plans to increase infrastructure spending may lead to a surge in infrastructure sector bond issuance in 2017 and beyond. Finally, oil prices are likely to pick up as well, creating opportunistic credit conditions for those in that market.
Fantastic. And your last point regarding 2017 trends?
Well, Eric, that leads us back to the growth of financial technology. 2016 saw financial institutions further embrace technology with their operations. Earlier this year, JP Morgan announced a target spend of $9.4 billion annually in technology, with 40% of this to be in their investments and technologies category. With many financial technology solutions being implemented in numerous areas of banking, including lending, payments, and wealth management, we expect fintech to be increasing its importance in less explored areas of banking services, including capital markets and regulatory compliance. Okay, thanks, Eric. Let's move on to the theme of technology, specifically how technology can advance growth. In particular, how do you see technology helping to build stronger relationships with market participants?
Sure, Tony. As an investor, you've got some key relationships. Of course, the issuer relationship, the dealer relationship, internal relationships, and of course, other relationships like with the credit rating agencies, the market data providers, legal, etc. From the issuer perspective, we're able to suggest potential deals and forecast upcoming deals with deal size, probabilities on the basis of issuers' historical issuance pattern, and bond maturity schedule. We can look at credit market conditions. The other thing that we can do is we can manage an issuer scorecard. We're basically tracking quantifiable issuer relationships, calibrated metrics, including the amount of reverse inquiries they've communicated, and the number of meetings, board seats, equity holdings, and chat history, etc. The second one is the dealer relationship. So as an investor, you've got multiple dealers that you're dealing with. We can predict the deal dynamics. So we can look at the dealers most likely to lead the upcoming deals based on data such as historical deal syndicate, current banking relationships, league tables, etc. We also have a dealer KPI monitor, so we can get a comprehensive view of dealers' performance by analyzing multiple KPIs like historical order fills, secondary market trading volume, research and sales coverage, and other things like communication volumes, like if they're providing a certain level of service or communication volume through a certain channel like email, Bloomberg chat, phone calls, etc. We're able to capture that and manage those KPIs so that we can start ranking.
Great, thank you, Eric. So the fixed income markets continue to remain a very manual and time-consuming process to patch information together. How do you see technology helping to optimize operational efficiencies and regulatory for investors?
Sure. Many of our investor users have a central depository for deal and issuer related documents like a prospectus, financial statements, credit rating reports, investor presentations, roadshow materials, etc. Some of them don't. So we provide a centralized repository where the documents are fully integrated with the deal dashboard and the issuer directory. They can have instant file search and retrieval, custom searches and folder structure automation, And of course, for the investors that already have a system, we can provide our flexible API to integrate with either a Bloomberg Research repository or maybe a proprietary document management system that's in use today. For compliance management, we can integrate and streamline the reporting process. We find that there's a lot of interest in tailored compliance mandate lists. Investment teams and compliance teams like to collaborate through this interface. Compliance likes the actionable task monitoring and tracking tools, and we also provide instant access to online compliance libraries for document templates, regulation guidelines, and recent policy updates. For order management, we provide an easy online order submission to syndicate dealers. We can also aggregate orders from multiple ends, dealer-investor relationship management modules, complete deal order history, live deal status, allocation notification, stuff like that. Approval facilitation. Now this is interesting. We can provide compliance integration to streamline the reporting process. We've got deal-tailored compliance mandate lists, investment team and compliance team collaboration interfaces, compliance actionable task monitoring and tracking tool, and also instant access to online compliance libraries for document templates, regulation guidelines, and recent policy updates.
Great. Thank you, Eric.
Tony, regulatory compliance is a great consideration for all players in the financial services landscape. Can you touch on some of the challenges that are being faced by practitioners in the marketplace?
Yes, in today's landscape, Eric, more stringent and changing regulatory environment makes it important to ensure that capital market participants are equipped to meet the requirements. Data availability and record keeping through technology is a strong theme for all leading capital market participants. In terms of challenging regulatory requirements, we are seeing three core difficulties. First, financial regulation has become increasingly demanding post-global financial crisis. Additionally, regulators are placing a strong emphasis on risk reporting challenges banks' current compliance framework. Finally, financial institutions are challenged to comply with fast-changing requirements from various regulators in multiple jurisdictions.
Are there any other challenges with regulatory compliance that financial services are currently facing?
Yes, more specifically, the aforementioned challenges result in a more complex reporting process. First, distributed, internal, and legacy IT systems complicate reporting processes and increase compliance risk. This poses a major efficiency and accuracy challenge, as most financial institutions still rely heavily on a manual process to manage, analyze, and prepare data. To further exaggerate this issue, exponential growth in financial products and transaction data further complicates the situation. To build on this, there are now increasing compliance costs involved in increased regulatory measures. On average, large global financial institutions spend over $1 billion annually in compliance, a considerable expense for most companies. The consequences from improper regulation management have been quite costly for companies worldwide. Regulatory fines and settlements in 20 large U.S. and European banks increased by 45 times between 2010 and 2014, according to McKinsey 2016 report on best practices of bank compliance. In 2016, Deutsche Bank alone faced a $14 billion fine for misleading bonds during the financial crisis.
Great. Tony, how might an investor deal with compliance issues?
Well, Eric, this goes back to our discussion on technology integration. Compliance costs and risk can be managed through adoption of a digital record-keeping platform. By integrating technologies, including what we offer on the Overbond platform, you can find solutions that actually enhance regulatory functions, and here is how. Using the Overbond as an example, as that is something both you and I are familiar with, we see reduced compliance costs. Reporting is standardized by being able to map compliance tasks to relevant business units according to their fixed income market activities. You also have better risk control. Enterprise governance frameworks are now applied to your internal standardized process and data solutions. Also, you're now seeing actionable regulatory intelligence. Through the use of advanced data analytics, regulatory risks and issues are now able to be identified proactively.
Thank you, Tony, for those very insightful insights. Let's move over to the Q&A portion of our call. Do you have any questions? Okay, our first question is, who uses Overbond, and is Overbond a dealer? Good questions. So the top users of Overbond are issuers, dealers, and investors. So we work with both corporate and government bond issuers, small, medium, and large dealers, including global dealers, and bond investors. In terms of third parties, we work with credit rating agencies and regulators, of course. Overbond is a fixed income financial technology enabler that streamlines all stages of the bond origination process. So we are not a dealer at this point. We're not regulated. Okay, our second question is, what kind of fixed income securities does the Overbond platform support? So today the platform supports corporate investment grade bonds, corporate high yield bonds, maple bonds, international bonds, convertible debts, green bonds, asset-backed securities, and peer-to-peer lending portfolios, and more. We're constantly adding additional bond types to our platform, to our network. Okay, our third question is about the security features of the Overbond network. Great question. Overbond's infrastructure relies on bank-grade security and encryption. The network uses a secure Amazon cloud-based technology with industry-recognized certifications and audits. All the data generated through the application is encrypted using industry-leading techniques. Okay, that's all the time we have for questions today. If you do have additional questions, of course, they're always welcome. You can email our dedicated support team at info@overbond.com, and a support professional will get back to you within 24 hours. Tony, thanks for joining us today, and everybody have a great day. Thank you.